Here is a view from Sunil Singhania, founder at Abakkus Asset Managers, in conversation with Nikunj, discussing markets and sectors that could benefit after the current volatility.
This is an event which obviously causes a lot of scare because it has got to do with your health and survival rather than anything else. I would say that the way this event is different from earlier instances is that news flow is like there every second. We are in this world where we are connected. We get to know everything. Rumors spread very fast. Cases are being assessed on a minute-to-minute basis, and I think that is where this fear factor, I think, is increasing very sharply. Even in India, we had fresh cases, particularly in one city, one group of foreign tourists. But the fact is that suddenly, from 6 cases, we have 25 or 29 cases even in India. And I think that definitely is causing a scare. We have a big festival coming up. Everywhere, Holi is being sort of curtailed or cancelled, which is again a good move because it's a precautionary move. But I think we are in this phase where markets apart, economy apart, there is now a fear psychosis, and rightly so. As far as global markets and global economy is concerned, there is absolutely no doubt that we are going to have a period of a quarter at least where growth rate will go for a toss because people are not traveling, no one is in a mood to do anything. Obviously, one country which is in the epicenter, China, feeds a lot of other countries in terms of raw material, is a big buyer, and I think 1 quarter of economic growth is gone for a toss. At the same time, I would say that the markets have been up there. A lot of markets have already reacted. And for a change, I would say the central banks across the world are also taking unprecedented actions. So it started with the Australian Central Bank, you have the US Central Bank, and one can expect a huge sort of stimulus which can come up as far as the global economy is concerned. But I think the next 15 days in particular is going to be the period where we will know that whether this is subsiding or whether it is going towards a full-fledged epidemic. My view would be that if the second is not true, that if it is not going into a full-fledged epidemic and it shows signs of abating or stabilizing, then the markets are poised for a sharp up move, at least recover to a major extent what they have lost because of the huge stimulus which is coming in.
So a year from now, when we would be discussing February 2020 and March 2020, will that be considered as one of those finest buying opportunities? Because now there is fear, there is panic, there is pandemonium, and like we say, blood on the street.
So Nikunj, very surprisingly so, and obviously we are in a serious situation, and it doesn't make sense for us to
We're talking financial
laughing
markets
about
here.
it. Yeah. But actually, if you go back, we have very short memories. Do you remember the biggest concern which we were facing in the first quarter of 2019? And no one remembers it. No one remembers Mr. Kim, and no one remembers North Korea, and whether the nuclear button is big or small. That also was a concern which could have destroyed the world. But we forgot about it because new ones came in. So as I said, if it doesn't turn out to be a very big epidemic, then I'm very sure we'll have forgotten about it 3-6 months from now. And as you rightly said, particularly in a lot of stocks, prices have come back to the level from where they started moving in. Even companies which declared phenomenal results and saw a 30-40% move up are back to the levels where the results, pre-result sort of prices. So I think there is definitely opportunity. At the same time, there is uncertainty. And I think as an investor, the only thing we can say is that, start nibbling. Particularly stocks which you like, fundamental basis, you'll never be able to catch the bottom. And there is a fair chance of 80-90% probability that this will subside. Maybe, there's a 10-15% probability that this might become an epidemic, but that is something which is not in your control.
Okay. Central bankers clearly have followed this approach of we will do whatever we can do to fix the problem, which means more liquidity, decline in bond yields. Because of abundant liquidity, we have seen that money is gravitating towards few stocks, and few large cap stocks have benefited. So if the lay of the land is not going to change, are we in for that repeat of 2018 and 19 where 10, 15, 25, 30, 50 stocks will do up?
I think you very clearly know my views on that, and we have spoken about it, and I have repeatedly said that there is definitely a bubble in quality, particularly in the 15, 20, 30 stocks which are trading at very high P multiple. See, ultimately, equity investing is all about discounting the future earning potential. And yes, you are right that if liquidity surges and if interest rates fall to such an extent, then P multiples overall rise. But we have also to see from a scenario that there will be a lot of sectors which are right now not in favor, which would benefit big time. Because post the US-China trade war, there was already a move from some companies to move production capacities elsewhere. And in that move, a lot of ASEAN countries were benefiting, like Vietnam and Thailand and Malaysia and Indonesia. I think what this coronavirus has done it has made the whole ASEAN bloc as one, and India to some extent is isolated from that bloc. And I think this move of shifting of production or partial shifting of production will gain ground, and India might stand to benefit. And I think hard assets also stand to benefit, because if there's a fiscal stimulus, almost all the countries will spend a lot of money in pumping up infrastructure, creating maybe more hospitals, I don't know, and that is where the neglected sectors would also stand to gain. On the consumption front, in fact, there is some concern, because if people don't go out, people don't go to see movies, people don't go to restaurants, the celebrations are curtailed, then you might have some of these sectors which get benefited positively getting impacted. But by and large, I think whenever there is a loose monetary policy, interest rates fall, we have this concept of carry trade which comes up. And as I said, it all depends on when this situation becomes normalized. But the moment the situation becomes normalized, if an investor in US can borrow money at 1%, there's a lot of incentive to borrow there and invest in countries where the yield can be maybe 8, 10, 12%. And that is where money can flow in back into the emerging.
Which are the sectors or companies or themes you think you will benefit because of shift in world? A, China because of trade war, now because of de-risking after coronavirus, and C, disruption in supply chain. India will gain. How can investor gain because of that?
So I think there are a few very obvious sectors. I think chemicals will definitely gain.
Do you own chemical stocks?
We do own some, but as I said, the valuations were a little discomforting, and in this current downfall, we might be able to find good opportunities. I think pharma has been on a downturn for quite a long period of time, almost since 2015-16. Particularly the US-facing pharma companies have not done well. There is still stress there in terms of growth. India-facing pharma companies on the other hand have done phenomenally well, where some of the companies having doubled, tripled also. But a lot of these mixed companies like Dr. Reddy and Cipla and Sun Pharma and Lupin, who have both domestic as well as offshore businesses, are getting punished because of their US exposure. But if you just look at their India sales and India business, I think the market cap is not even discounting that. So some of these companies will come back into
the good old Lupins and the Ciplas of the world.
But it is early, but you have to now start looking at them. There are definitely going to be some disruptions, because Indian companies were also dependent a lot on China to supply them with the basic raw material. So I think company specific wise, it's frankly, we don't know which company was buying what from China. I don't think anyone has done that in so much detail. So you have to depend on what the company is saying. But I think by and large, this can again be a sector. I would also say that some of the brick and mortar sector, like metals, for example, obviously the metal prices have fallen post-corona because China is supposed to be one of the biggest consumers. But the prices are now like less than half-time book for a lot of these metal stocks. And these cannot be structural plays, but I do expect that once the stability comes in terms of this virus, there might be a big bounce in some of these sectors. So you can maybe play for the bounce.